Welcome to Section 6 of the ASC 710 training series. This section brings together the journal entries and financial statement presentation rules for the key compensation liabilities we have studied: vacation accruals, deferred compensation, rabbi trusts, and termination benefits. Mastering the debits, credits, and balance sheet classifications ensures your financial statements are complete and correctly presented. By the end of this section, you will be able to record the full set of journal entries for vacation accrual, vacation use, and vacation payout on termination. You will also record entries for deferred compensation accrual and rabbi trust funding, as well as entries for both voluntary and involuntary termination benefits. You will classify each liability correctly as current or non-current, and identify the disclosures required for each compensation category in the notes to the financial statements. The vacation accrual entry is recorded each period as employees earn time off through their service. The debit goes to vacation expense on the income statement, and the credit goes to accrued vacation liability on the balance sheet. The amount is based on the hours accrued during the period multiplied by the expected pay rate plus employer payroll taxes. If the policy includes expected forfeitures, the gross liability is reduced by the forfeiture estimate before recording the net liability. When an employee actually takes vacation time, or when a terminated employee receives a cash payout for unused vacation, the entry is a debit to accrued vacation liability and a credit to cash. No additional expense is recognized at this point because the expense was already recorded in the period it was earned. If the actual cash paid on termination differs from the accrued amount, for example due to a pay rate change, the difference is recognized as additional expense or as a reduction of expense in the period the payment is made. The deferred compensation accrual entry mirrors the vacation accrual in concept, but typically covers a longer horizon. Each accounting period, a debit is recorded to deferred compensation expense, and a credit to deferred compensation liability for the portion of the total deferred benefit attributable to the current period's service. The liability accumulates on the balance sheet over the entire service period until the employee has fully earned the benefit. At that point, the liability equals the full future obligation, and no further accrual is needed until the terms of the plan change. When the employer funds the rabbi trust by transferring cash, the entry is a debit to rabbi trust assets and a credit to cash. Because the trust assets remain on the employer's balance sheet due to creditor exposure, the debit simply reclassifies the cash into a trust asset account. If the trust assets are invested in marketable securities, those investments must be remeasured to fair value at each balance sheet date. The change in fair value is recorded by debiting or crediting the rabbi trust asset account with the offsetting entry going to the income statement. When the employee retires and the deferred amounts are paid out, two entries are typically required. First, if trust assets must be liquidated to generate the cash, the entry is a debit to cash and a credit to the rabbi trust asset account. Second, the actual payment to the former employee is recorded as a debit to deferred compensation liability and a credit to cash. Together, these two entries extinguish both the asset and the liability. Because the expense was recognized over the service period, no additional expense is recorded at payout. For voluntary termination benefits, the recognition trigger is employee acceptance. On the date the employee accepts the offer, record a debit to termination benefit expense and a credit to termination benefit payable for the agreed amount. The liability stays on the balance sheet until the cash payment is made, at which point the entry is a debit to termination benefit payable and a credit to cash. If the exact amount is not yet known at acceptance, accrue the best estimate and adjust in the period the final amount is determined. For involuntary termination benefits under ASC 420, The entry is recorded only when all four criteria are satisfied, including communication to employees. The entry is a debit to restructuring expense and a credit to restructuring liability. As individual severance payments are made over the following weeks or months, each payment reduces the restructuring liability with a debit to restructuring liability and a credit to cash. The restructuring liability should be reviewed at each balance sheet date and adjusted if the estimate of total benefits changes. Each compensation liability must be classified as current or non-current based on when it is expected to be settled. The vacation accrual is almost always a current liability because most employees take their time off or receive payouts within 12 months. Deferred compensation liabilities and corresponding rabbi trust assets are usually non-current because they are tied to retirement, which is typically more than a year away. Restructuring liabilities should be split between current and non-current based on the expected timing of individual severance payments under the plan. Beyond the balance sheet and income statement, companies must disclose their compensation policies and liabilities in the notes. For vacation accruals, disclose the policy terms and the measurement basis. For deferred compensation, describe the plan terms and the method used to accrue the obligation. For rabbi trusts, the notes must specifically disclose that the assets are subject to general creditor claims. For termination benefits, disclose the nature of the plan, the total amount accrued, amounts paid to date, and the expected timing of remaining payments. Let us review the key takeaways from this section. Vacation expense is recognized as earned, and the liability is debited when the employee uses the time or receives a cash payout. Deferred compensation is accrued over the service period, and the rabbi trust asset and liability are presented gross with no offsetting. Voluntary termination benefits are recognized when the employee accepts the offer. Involuntary termination benefits are recognized under a ASC 420 only when all four criteria are met. All compensation liabilities must be classified as current or non-current based on expected settlement dates. Thank you for completing Section 6 on journal entries and financial statement presentation.